Well, thanks for joining us today. My name is Jay McGowan. I'm the Director of Financial Planning here at Five Plan Partners. And today I want to talk a little bit more specifically about some key provisions of the Secure Act, or Setting Every Community Up for Retirement Enhancement Act. I did a vlog on this in 2019, late in 2019, before it had actually passed. Now that it is law, I want to talk about a few provisions that most specifically affect our clients. So the two most impactful provisions of the Secure Act are the elimination of the stretch IRA, as well as the delay of required minimum distributions from age 70 and a half to age 72. So for the elimination of the stretch IRA, and basically, if you remember, an IRA account owner, when they passed away, if their account went to a non-spouse beneficiary, that beneficiary could take required minimum distributions over their life expectancy. Now, as a result of the Secure Act, that has been reduced to a 10-year time frame in which beneficiaries can take distributions. Now, one thing to note is there's not a required minimum distribution in years 1 through 9. The only rule is that it has to be, the entire account balance has to be distributed out of the inherited IRA at the end of the 10th year. Therefore, you can take it equally over 10 years, you can take all of it in year 1, you can take all of it in year 10, or any combination thereof, except the only rule is that the entire balance has to be distributed from the account by the end of the 10th year. Obviously, this could have a great impact on tax consequences. For those people that have extremely large IRAs and they pass away and leave those to non-spouse beneficiaries, you can imagine, say you have $1 million IRA that you pass on to your children. Well, they either have to take $100,000 a year for 10 years, or they have to take $1 million, or any combination thereof, and it can produce a significant tax impact to their tax situation, depending on what their earned income or tax situation is on a personal level. There are a few exceptions to the new elimination of the stretch IRA provision. The first is obviously if a spouse inherits the IRA, the 10-year rule does not apply. Disabled persons, chronically ill persons, the rule does not apply to them either, and it's based on the old rules. So another exception is that if the beneficiary is less than 10 years younger than the decedent, then the 10-year rule does not apply to them as well. And also, minor children are not subject to this while they are minors. The old IRA distribution rules apply. When they hit the age of majority, the 10-year clock starts. Some potential planning considerations for this. There's a lot of tax implications, a lot of tax impacts. What we're looking at with our clients is going through and reviewing who the beneficiaries of your IRAs are. There may be some opportunities to give these to charities. There's also a potential to do more Roth conversions in order to get the money out of the IRAs before you pass away. Go ahead and pay tax on those now, allow them to grow tax-free. The 10-year rule does apply to Roth IRAs, but you don't pay tax on the distribution, so it really doesn't matter. In that situation, we would probably recommend leaving it in for the Roth IRA for the entire 10-year period and then taking a distribution at that point. Some other potential strategies are between the ages of 59 and a half and 72, you can potentially take IRA withdrawals out even though you don't have to. And you can buy life insurance, cash value life insurance policies, things like that. Again, these are very specific to each individual's plan on what the strategies may be. And then really, there's another potential planning strategy, and that's really to do nothing and keep things as is. If we look at your situation and realize that it's not an issue for the beneficiary to inherit the IRA and take it over a 10-year period, then we may want to say, we just leave it as it is, let it grow tax deferred, and keep the plan as is. The second big component of the Secure Act that's affecting our clients is the delay of the required minimum distributions on IRAs and qualified accounts from age 70 and a half. It's been pushed back to age 72. So the new required beginning date is actually April 1st of the year after the individual turns 72 years of age. So this is effective for those who turn 70 and a half in 2020 and later. So if you turn 70 and a half in 2019, you still have to take your required minimum distributions as you did in 2019. There is no impact on this legislation for the date in which you can make qualified charitable donations out of your IRA, so that doesn't impact this. You can still begin doing that at age 70 and a half. So one cool thing about this is that if you think about it, no individual will actually start taking required minimum distributions in 2020. Just the way that the legislation falls, beginning in 2021, people that turn 72 will begin taking those required minimum distributions at that time, but nobody falls into it in 2020. So if it was your year, you get a break. So one big planning opportunity is this gives people who can afford to wait, who do not need to take money out of their IRAs, 2 more years to do some tax planning strategies with this new legislation. Some of the key things that this allows us to do from a planning perspective will be Roth conversions. We can also do current and future tax plannings related to Medicare strategies, IRMA, things like that. We can control your income a little bit, both now and in the future because of this law. It gives us another couple years to do that kind of planning. And then it also gives you another 1.5 years, 2 years of additional tax-deferred growth in your IRAs. So these Secure Act changes are a great example of how legislation, rules, laws are always changing, always evolving, and that really is important when it comes to your specific financial plan. As these things change, it can impact your plan in certain ways, and certain things may not impact your plan, but it's so specific to your financial house, and that's why we want to continue the dialogue with our clients at least annually, go through, update the plan, their specific plan, because things may or may not impact. The world we live in is constantly changing, and we value the opportunity to get to work with you and update your plan on an ongoing basis as things change and as things stay the same. There's always changes in your life as well, so please don't hesitate to reach out if you have any questions how this relates to your specific plan or just questions in general. Thanks and have a great day.